Over the past 10 years, Capital Southwest has outperformed the S&P 500 for total return, but recently the price fell. This caused the yield to shoot up to 11.8%. Capital Southwest has a long history of paying consistent dividends, so is this a buying opportunity? Today we're going to cover the income from Capital Southwest, why the price fell recently, and whether that makes it a more attractive purchase. If you want more details about how Capital Southwest makes money and its pros and cons, I'll link to this detailed review in the description. For now, though, I'll just say that it's a business development company that lends money to medium-sized businesses. We need to use this fairly colorful distribution history chart from the October investor presentation to understand the three types of dividends paid by Capital Southwest. The most important color is blue, the regular dividends. The trend is clear: no cuts and 9 increases since 2001. I like that. Orange represents supplemental dividends. These are extra dividends paid when economic conditions are favorable for their lending business. And as we'll see, that's most of the time. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's available via Armchair Insider, link in the description, it's free. Let's continue with the income. Green represents the special dividends. These are paid when there's a one-time boost to earnings. For example, if the BDC takes an equity stake in the borrower's business and that borrower is sold to another company for a profit. In that situation, Capital Southwest could receive a substantial one-time payment. Now, taking an equity stake in a borrower's business is one of the key differences between banks and BDCs. Banks can't take ownership positions, and BDCs can. Compared to accepting loan repayments in the form of cash, this is high risk, high reward, and represents 8.9% of Capital Southwest's loan portfolio. I'll give you an example. In Q2 of 2024, Capital Southwest was able to sell the equity positions it held in these 4 businesses for just over $45 million, generating an internal rate of return of 14.5%. Not bad. Let's go further back in time to a chart from my original review of Capital Southwest. During the pandemic of 2020, there were no dividend cuts and they continued to pay supplemental dividends. And here's a much simpler view. Total dividends per year from 2016 shows a rising trend with 2 anomalies. 2019 and 2021 delivered unusually high special and supplemental dividends. This chart came from Snowball, but I mostly use Snowball to combine my stocks from 3 brokerages into one simple dashboard. Sometimes I'm looking to sell low-yielding funds to buy higher yield, so I'll rank by yield to see how I want to rebalance my portfolio. And the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for a discount and a free trial. This downward slope looks out of character on a 1-year price chart and a little less dramatic on a 5-year price chart. Just like REITs, BDCs are required to pay out at least 90% of their income to shareholders. Therefore, most of the returns come from income, not price. So price charts don't tell the whole story. If we include distributions and zoom out in time, we can see the big picture. This 5-year total return chart includes price movements and distributions for Capital Southwest and the S&P 500. Sometimes Southwest outperformed the equities market and sometimes it underperformed, but clearly it is competitive. If we zoom out to a 10-year total return chart, it's not so competitive. Southwest has beaten the S&P 500 for total return throughout most of the decade. I wanted to give you that context because the recent price dip looks dramatic on a 1-year chart, but the big picture is actually pretty good. The real question is, what happened in October 2024? The answer is that Southwest released its Q2 earnings. I copied the earnings call transcript from Seeking Alpha onto this document, and it's 6,500 words long. Let's read it together. Thank you for joining today's Capital Southwest second quarter fiscal... I'm just kidding. We're not going to read the whole thing. There were 2 key items that came up during the call. The most important issue, in my opinion, was an increase in non-accrual loans. These are loans where the borrower has stopped making payments. Non-accrual loans in Southwest's portfolio increased from 2.3% in Q1 to 3.5% in Q2. is 3.5% high. The best data I could find on that is a paid newsletter I subscribe to called Systematic Income Investing. Their BDC tool covers 30 BDCs, and the median non-accrual rate is 1.2%. The average is 2%. I counted 5 BDCs that had higher non-accrual rates than Capital Southwest. So I would say that Southwest's 3.5% is high enough to warrant further monitoring, but not a major red flag. This newsletter is $29 a month, and I've tried to get a discount for Armchair Income viewers, but no luck. They don't have an affiliate program. I would say it's more suited to the hardcore BDC or preferred share investor as opposed to the mainstream income investor. I think some investors read 3.5% and sold their shares because Southwest has been a very expensive stock, as we'll see shortly. But we can learn more from what the CEO said during the earnings call. He responded to a question from an analyst about this subject by explaining there were 2 loans that caused the quarterly increase from 2.3% to 3.5%. One was a discount retailer serving low-income consumers, which has struggled recently due to inflation. The second loan was to a video content editing company affected by the Hollywood writers' strike. More importantly, the CEO said that he expects both loans to be restructured by the end of December, so hopefully it's already happened. Non-accrual means late to pay, but it doesn't necessarily mean the lender won't get paid. The restructure might involve extending the loan term or switching to interest only for a defined period. If that doesn't work, Southwest can foreclose on the loan, force liquidation of the collateral securing the loan, and in almost all cases, they're in first position to collect the proceeds of that liquidation. If the non-accruals keep trending up or the restructuring fails, then this becomes a more serious issue. But at this point, I think the market has overreacted because Southwest was priced for perfection. The second issue was that the supplemental dividend was reduced from 6 cents to 5 cents. This was a sign that the Fed lowering interest rates would also lower income for Southwest and BDCs in general. That's because the interest rates charged by BDCs move up and down with the Fed funds rate, whereas the funds borrowed by the BDCs are, to some extent, fixed. It's a valid issue, but supplemental dividends, by definition, are not supposed to be reliable, and I'm not overly worried about the supplemental dividends disappearing completely because of rate cuts. The Fed funds rate was 0 back in 2020 and 2021, and Southwest was still paying supplemental dividends during that time. More importantly, the regular dividend is covered. For Q2, net investment income was 64 cents per share, covering the base dividend of 58 cents. On top of that, they have another 64 cents per share of undistributed taxable income, or UTI, up their sleeve. This is like a reserve fund of distributions they can pay out when times are tough. The last issue occurred after the earnings call. In November of 2024, Southwest issued $200 million in convertible notes to fund new loans. It's common for the market to react negatively because that dilutes existing shareholders, but that's a debatable issue. If the BDC issues debt and doesn't do much with the money, then it would be dilutive if and when the convertible notes are converted into shares. But if the BDC uses the new capital to fund profitable loans that grow the value of the company, then it can add to shareholder value. So I don't typically sell a stock just because the company issued debt. If the 3 issues I just covered don't bother you, the question becomes, is Capital Southwest more attractive to buy now? The short answer is yes, but it's still not cheap. The most common way to value BDCs is to compare their price to their net asset value, or NAV. Raymond James tracks the price to NAV for 46 BDCs, that's pretty much all of them, and the average is a whisker under 1, meaning the price per share is roughly equal to net assets per share. We can see Southwest's historical price to NAV ratio on Seeking Alpha. It peaked at 1.63, which is very high, and now it's at 1.3. Looking back 3 years, it has been lower than 1.3 in the past, almost down to 1 in 2022. This chart came from the comparison tool on Seeking Alpha. I did a walkthrough of this and 3 other tools I use the most in this review. Of the analysis articles I researched for this video, the most interesting was this one by Cashflow Venue. It does an analysis of the effect of interest rate cuts on Southwest's dividends, like a projection. I'll include a link to that analysis and a link for a discount and a free trial for Seeking Alpha. I use the premium level of membership. Going back to Raymond James, they rank 46 BDCs by price to NAV, and Southwest is still the 4th highest. That's why I said it's not cheap. But then again, quality companies like this rarely are. It outperformed the S&P 500 over 10 years. That's not normal for a boring old lending business. I'm not surprised by the recent price decline. Southwest was so richly valued that anything other than fantastic news was going to hurt the valuation. It would be like Nvidia having an okay quarter instead of knocking it out of the park. The price would take a beating. If I didn't hold Southwest, I'd be starting a new position now, and if the price keeps falling, I'd keep buying it unless new information changed my outlook. However, I already have some Capital Southwest that I bought in 2023 at a cost basis of $18.30, and I also hold the PBDC fund, and Southwest is 3% of that portfolio. So I just added another 1%, but my cap on any one stock is 5%. If you want to learn more about the business model behind Capital Southwest and its pros and its cons, click here for the Capital Southwest review. That wraps it up for this Capital Southwest update. More Armchair income coming soon.